So what happens to the U.S. housing market if the U.S. goes into war full on with Iran or with any other country? Well, we can learn from the past from this, and I've got 4 things to go over with you that you can keep your eye on. Welcome to Housing Data Nerds, where we go over the data for the U.S. housing market. Today, I'm going to call this War Watch Signals for the U.S. housing market. Now, I'm going to share a few things on the screen so you can see them as we go, so you can see where we're currently at and where we could be going just in case. Here are the 4 things you need to watch out for. Number 1, according to what I just outlined, is the 10-year Treasury yield and the 30-year mortgage rate. You see, they are connected, and every time the 10-year Treasury goes down, the mortgage rates go down. If they go up, then they go up. Now, sometimes there's a disparity in between there, but you can always rely on, if you take a look at this graph, it always goes with it. And you can take a look right now, it's a little lower, and now they may be preparing for what could happen, right? So keep a very close eye on that. And here's why it matters. Bond markets are the first to react, as we may be watching right now. A flight to safety usually pushes Treasury yields and mortgage rates down in the opening weeks. So pay attention to that one very closely. If the conflict drags on, it will definitely fuel inflation, and now we're going to have a different challenge with all that. That's a tough one. How to track it? Check the 10-year daily, and if it breaks 4%, that can ignite short-term buying. And it could put rates into a lower amount than where they're at right now, which is a great thing for home buyers, right? Imagine if rates hit 5.5. That changes the landscape of the current real estate market. All right, number 2, oil and shipping costs. Why it matters. Wars that disrupt energy or trade routes raise fuel and material costs, feeding inflation. Again, the inflation beast, right? Higher inflation keeps the Fed hawkish and mortgage rates higher for the longer. As long as there's an inflation problem, the Fed's going to look at it and be like, well, why are we going to lower any rate if there's an inflation problem? In fact, we may need to raise it. So keep an eye on that, because you'll see here the rate has dropped over the last 2 years steadily, but it's kind of stayed the same, right? It's not gone up or down, and that's because the Fed's already stated that there's just too much uncertainty with the tariffs and now with the war, right? So keep an eye on that. Next, 3, consumer confidence and, more importantly, job cuts. Because if you look at what I'm showing you right now, this graph shows unemployment, and unemployment has stayed pretty low, which, I mean, in COVID was crazy, but it quickly recovered. It's like, oh, got it. We can all work. And it stayed pretty healthy. And that is one piece that the Fed didn't quite think would happen. This matters because even a small drop in confidence or an uptick in layoffs can sideline buyers. Buyers meaning buyers for property, because if there are less buyers to purchase, that means their inventory is going to continue to grow. And right now, you do see an affordability issue. But if unemployment hits a snag and all of a sudden that number starts to skyrocket, keep an eye on that. Here's how to track it. Follow the Conference Board's Consumer Confidence Index and weekly unemployment claims. Multi-month sliding confidence or claims trending above 275,000 would point to softer home demand. So watch for that. And number 4, the last one here, months of supply. Why does it matter? Well, look, for many years through COVID, the supply of homes that were available were exceedingly short. We just needed more inventory. And now we're on the way up, which means if you look at the numbers, we just hit over 1 million homes active on the market. And that's crazy because we're at about a little over 4 million year over year sold homes. An inventory to be at under 1 million at any point, man, that is crazy. Just not enough selection for buyers. And now you're watching Florida and Texas and some of these southern states that are now struggling. You're getting a lot more condos up for sale, a lot of new construction with discounts, and then on top of that, the regular homes for sale. So it's driving inventory up in those areas, which is allowing some buyers to be able to purchase at a much greater discount than before. Here's why it matters. Inventory tells you whether sellers or buyers hold the cart. If months of supply climbs past 5 months, yeah, that is a normal, which is crazy. You're watching only a few areas have over 5 months of supply, and this is for the average home price. If we're looking at luxury homes, that timeline is way higher because sometimes it takes years, right? Expect price cuts if we're looking at the average home staying longer than 5 months on the market. If it stays under 4, I would say right now under 3, prices can hold up even in a turmoil. So keep an eye on that because you've got our area, LA, Ventura County. We're at around 3.5 to 4, which gives us a pretty even market, right? As long as we stay there, we should be okay. But your market, what is it? How to track, pull NAR or Redfin weekly data. You can pull Realtor.com data as well. A sharp jump in active listings without matching sales is an early warning for price softness. So watch out for all of that, because if we do go into any war and it drags on, what happens is prices get a little softer, because we go back to number 3, consumer confidence. It's like, well, why am I going to buy anything if I have even more uncertainty? So all of this matters. And this is why you have to keep an eye on what's going on in your market, because even across the United States, great markets, meaning things that are selling quickly, versus not so great markets where things are coming down in price, are all over the place. Keep an eye out in your market. Please, if you think somebody benefits from this video, share it with them. Housing data nerds, thanks again.